Hey there, small business owners. Are you familiar with the deadlines for retirement plans? I know there's usually an alphabet soup of retirement plans, 401ks, SEP IRAs. You can still fund traditional and Roth IRAs as a business owner. But how does that work? What are the deadlines? How do we do it? I'll tell you right now. 401ks, those can be funded at an astronomically high rate. And again, we work with a multitude of business owners, and you have to understand whether you have other employees that you have to bring into the plan, or if you're a solo owner, because the strategies here are going to differ dramatically. If you're a business owner with multiple employees, you have to make sure that you treat everybody kind of equal when you're funding and matching the plan. In those situations, the funding is a little bit less, but you still get the standard $22,500 contribution, which is called the employee deferral, which is your deferral into the plan. Whatever you choose to match for yourself and employees, that you have to consider, hey, will I have to match other employees this amount? Do I want to meet that close to $70,000 limit and match it to all my other employees? Probably not. Let's move over and see where we can really do kind of like a mega contribution, and that's for solo employees. So if you're the only person working, or if you have part-timers that don't qualify to be part of your plan, or if you have high turnover, what you can do is set up similar 401k plan and then fund it to the maximum. We're talking about the $22,500 regular contribution, which is the employee deferral. It's close to $70,000 right now. You can potentially match up to that, but keep in mind that match, it has to equal at least 25% of your W-2 in order for it to qualify. And that can be a huge contribution and a deduction on your tax return. Now, when can you make these contributions? The plan actually has to be established by the end of the year, which is December 31st of the year that you plan to contribute, meaning it has to be in existence. You can't create it after the fact, like a SEP IRA account or a traditional or Roth account. That can't happen. It has to have been established by year end for you to qualify for that deduction. The beauty here, though, is you can do the match before the due date of the tax return, April 15th of the following year, or March 15th, depending on the entity structure. That's something that you have to be kind of conscious about. Also, what you have to keep in mind, when you make 401k contributions, the employee deferral, so let's use that $22,500, that deferral is out of your W-2 paycheck. We're decreasing the income tax liability just from the income tax portion. That $22,500 is not deducted from the FICA tax portion. So you're still paying Social Security and Medicare tax on that income that you're shoving into that 401k plan. So you make $100,000 on your W-2, your W-2 is going to show on box one, it's going to show $100,000 less $22,500, which is $77,500. So $77,500 is what you're going to pay income tax on, but you're still paying Social Security and Medicare tax on that full $100,000. Let's shift over to SEP IRAs. Similar concept to 401ks, those plans do not have to be established by 12/31 of the year that you're making the contribution. You could actually, one of the rarest cases in the tax code, actually turn back time. You can get into your time machine essentially and go back to the previous year and fund a contribution for the previous year, as long as it's done before the due date of your tax return, including the extension, which can potentially give you a ton of time. So the SEP IRA plan could be established in the subsequent year and the contribution made for the previous year by either April 15th or October 15th, which is the deadline, or March 15th or September 15th, respectively, if it's an S corporation and not just on a Schedule C. One thing, though, that you have to keep in mind, here's the scenario. A small business owner actually forgot to make their SEP contribution for last year. Now we're sitting in 2023. They had the opportunity to make it by April 15th of 2023 for 2022. They didn't make that contribution. What they do instead, they had filed the tax return, meaning they finalized the return and they filed it without making that SEP contribution. The question was, can we go back and amend the tax return? Because in their mind, you can still make the contribution because you have that extension deadline. Can we go back and amend the tax return and show that contribution was still made before that extension deadline? Unfortunately, in this scenario, you cannot do that because the tax return had to have actually been extended on extension for you to qualify for that subsequent funding in the 2023 tax year. So you always have to be careful when you're planning for retirement contributions to know when those deadlines are, how to fund it, when the retirement plan actually has to be established, and the maximum contribution that you can contribute. And on that note, the maximum contribution for SEP IRAs is 20% of the net income of the business. One more thing that you kind of have to be cognizant of is one of my favorite things. With a SEP, we just spoke about the 401k and how you're paying FICA tax on that contribution. With a SEP, you actually are not paying FICA tax on that contribution, which is a nice little bonus. So the contribution that you make into your SEP IRA account is deducted from all taxes. Income taxes, you're saving on income tax, you're also saving on that FICA tax. And at 15.3%, that can be a juicy number that you can keep in your pocket. Who doesn't love to keep more of their money? We briefly spoke about traditional Roth IRA accounts. You can always set those up as an individual. Traditional IRA accounts, pre-tax, meaning you deduct it off of your income tax, you fund it, it grows tax-free, and then you pay the tax when you take the money out. The Roth IRA account is post-tax, meaning you fund this with post-tax dollars, you pay the tax, you fund the Roth IRA account, and then it grows tax-free, and when it's time for you to retire, or at age 59 and a half, you can start taking money out of that Roth IRA account and pay zero tax. You may say, hey, I don't really qualify for that Roth IRA account. I make way too much money. My accountant said that I can't do it. If you haven't, click the video. I spoke about backdoor Roths, which is one of my favorite strategies, which gives you the opportunity to still fund that Roth IRA account, even if you're above that income tax threshold. Check out my video, the link is going to be here. Those are, in a nutshell, the most common retirement plans that we work with for small business owners. There's a strategy to combine particular ones for your particular case. Speak to your tax professional, tax advisor, or just give us a call if you have additional questions. Thanks so much for watching. Like, share, and follow for more tax tips and to keep more of that money in your pocket.